The Crab Walk Thesis, Bitcoin's setup for 2026. Bitcoin is entering a prolonged consolidation phase characterized by sideways price action and volatility compression, likely extending into early 2026. This period reflects structural digestion rather than weakness, as speculative excess unwinds and long-term capital positions quietly accumulate. The next meaningful expansion is expected to be driven not by retail momentum, but by the resolution of regulatory frameworks, global liquidity conditions, and institutional and sovereign adoption dynamics unfolding through Q1 to Q2 2026. In this environment, disciplined accumulation, macro awareness, and patience, not leverage or narrative chasing, represent the optimal positioning for the next cycle. Core view: Bitcoin is likely to enter a prolonged consolidation phase over the next 6 months, extending into early 2026. Expect sideways price action and volatility compression, a classic post-expansion digestion period rather than a trend reversal. This phase will test conviction more than price levels. Momentum-driven participants may disengage, while long-term allocators quietly accumulate. The next decisive upside move is unlikely to emerge until institutional positioning and macro conditions resolve through Q1 to Q2 2026. If history rhymes, 2026 marks the next major expansion leg, potentially another structural green year, but the magnitude will be determined by capital flows, not narratives. Our strategy favors disciplined dollar cost averaging, selective patience, and active macro monitoring over short-term speculation. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. The macro backdrop. 1. Market structure. Post-impulse consolidation. Bitcoin has historically followed a pattern of expansion, then distribution, then sideways compression, then expansion again. Sideways markets are not dead markets. They are rebalancing regimes where weak hands exit and stronger balance sheets take over supply. Crab markets kill leverage. They drain retail attention. They set the base for asymmetrical moves later. This is not bearish. It is preparatory. 2. Institutional timing mismatch. Institutions do not chase volatility spikes. They wait for regulatory clarity. They demand liquidity depth. They allocate across quarters, not weeks. We are currently in a positioning lag, not a rejection phase. The real institutional flows will only become visible once compliance pathways solidify, balance sheets adjust to rate expectations, and Bitcoin is framed as strategic collateral, not speculative tech. That window points toward Q1 to Q2 2026, not the next 30 days. 3. Regulation as a gate, not a headwind. Crypto regulation is not a kill switch. It is a throttle. The market is transitioning from the question, can we touch this, to the question, how do we size this? This process is slow, bureaucratic, and invisible until it is not. Sideways price action is consistent with behind-the-scenes rule setting, not capital flight. 4. Global liquidity and the Japan carry trade. Bitcoin does not move in isolation. It responds to global liquidity gradients. Key forces to watch include Japan carry trade dynamics, where yen weakness leads to risk on flows, the repricing of global duration, and liquidity leakage from sovereign bonds into alternative stores of value. When carry trades unwind or reroute, Bitcoin benefits, but only once macro stress resolves, not during uncertainty. 5. Chips versus metals. The capital rotation signal. We are watching a quiet rotation. Chips represent growth, leverage, and future cash flows. Metals represent durability, sovereignty, and balance sheet hedging. Bitcoin increasingly trades between these two regimes. It is tech adjacent during liquidity expansion and gold adjacent during monetary stress. A sustained move higher requires Bitcoin to be reclassified as a balance sheet asset, not a momentum trade. 6. Central banks as the endgame buyer. Retail buys first. Corporations follow. Central banks arrive last, when it is already obvious. Early signals to monitor include gold accumulation rhetoric shifting toward digital reserves, sovereign wealth funds testing Bitcoin exposure indirectly, and stablecoin infrastructure normalized at the state level. Bitcoin as a sovereign store of value is not a 2025 story. It is a mid to late 2026 repricing event, if it happens at all. Strategy summary. Expect boredom, not collapse. Accumulate methodically via dollar cost averaging. Avoid leverage and overtrading. Stay macro literate, not chart obsessed. Treat 2025 through early 2026 as positioning, not payoff. The market is not asking for conviction, it is demanding patience.